Hey everyone, welcome back to Drawbridge Finance. My name's Levi Woods, and today we're talking about one of my favorite trades that I've been trading the last couple months, the unicorn. Now this is a trade I invented very specifically for low IV environments, and today I'm going to get into the nitty-gritty of how this works. Thanks for joining me today, and as always, I'm not a financial advisor. I don't work in the finance industry. I just love trading stocks and trading options, and I make a pretty good living doing so I like to share my experiences with you. Now, if you're like me and you want to have a community behind you, then that's why I have my private members-only chat room. So if you're interested in joining the chat room to chat with me directly, you can check out my Patreon page. I'm always online, and I'm online during the day, obviously, not always, but most of the time I'm online and I'm trading, and there's tons of trade ideas, and it's an amazing group. It has been so much fun, and it's kind of why I haven't been making as many videos as of late, because I've been super busy in there. But today I'm taking the opportunity to share with you one of the strategies that I like, which is the unicorn, and it's a strategy that I invented specifically for low IV environments. Now, I'm going to show you this trade, Micron. Let's take a look at the screen, because Micron is a trade or a stock that kind of moves around quite a lot. You see, it's quite volatile. But over the last year, it's only up about 30%. And now I say only because a lot of stocks are up more than that. Now, if we look at S&P 500, if we just type in SPY here, you can see a comparison. This SPY from 1 year ago today is up 28%, and Micron is up 30.7%. Now that's a fairly significant rise, but it's been a fairly significant year. Now, one of the things, if you look at SPY, how steady it's been just kind of climbing up at this kind of steady cadence. Whereas Micron has not. It's been jumping all over the place, these big spikes up and down. And that volatility is what makes it fun to trade. Now for me, I'm a premium seller, so when the IV or implied volatility is high, I can go ahead and I can sell any sort of premium strategy where I'm selling a put and I'm selling a call, and I'm expecting Micron to trade within a range. Now you guys saw a recent video of mine where I defended a Jade Lizard. It was a great trade, ended up being profitable. I think we were like a 60% or something. I searched for MU. We'll see all my MU trades. And here we go, closed for profit. Yeah, compounding annual return on investment, 66%. We made 5.9% in 41 days. And this was pretty interesting because this was closed October 7th, and we were in it for 41 days. So if you look at the chart, for me to get out on October 7th, which was here, 41 days before, we were back around here. So this stock actually dropped, and I made a 60% annual return. Now that is awesome. And part of the reason for that is because we're having these big moves. But sometimes when we look at these trades, the IV rank isn't very good. So if we look at MU right now in IBKR, only 5, which means it's in the bottom 5 percentile of its most volatile days. Now that's not a good time to be selling premium, but I want to be able to play it. And that's where the unicorn comes in. So let's pull up the options chart, and we're going to take a look. Now the market's almost over. And Friday's a perfect day to be looking at a unicorn because we can see the value of the calls. The idea with the unicorn is that we're going to make money off of the at-the-money calls, and I'm going to be rolling those at-the-money calls each week and trying to collect the premium out of the trade. So if I just change this tabbed view to list view, and I turn off some of these strikes, maybe we'll just go to 10, we can look at both October 15th and October 22nd on the same time. So let's just say theoretically that I was currently holding a 66 short call and I needed to buy it out. Now it's gonna cost me $1.50 approximately to close it right now, because this is just about to expire. The market's gonna be closed in 10 minutes. If I was to sell a new call for next week, even at that same strike, I would actually be collecting a net credit. So I would be buying to close the 66, selling to open a 66 in the following week. Now this generates a net credit of around 35 cents, which is about half the price of the stock valuation right now. So if I double this, 35 times 2, I'm at 70 cents, which is right around 1% of the value of the stock right now. And that's kind of the sweet spot. I want stocks that even when the calls are in the money, in low IV, I'm able to roll these for at least 1% value per week. because that's what's going to make this unicorn work. So it passes the first test because what I want to happen is for the stock to go up and test these short calls just slightly. So now to actually sell this, how would I actually set it up? Let's clear this off. And I would start about, a week out. I could either do 14 or 7 days, depending on how aggressive I am. And for the unicorn, I want to choose the at the money call because it has the most extrinsic value in it. You can see the 67.50, the stock's trading at 67.50, which means that all of the current value, 91 cents, is extrinsic. So I start with that. I'm going to be selling 2 of these calls. Now I'm going to go back to the tab view and I'm just going to zip forward in time and I'm going to go way out. I'm buying a leap. So the nice thing about this is that it sets up similarly to a calendar spread, but we have way more flexibility and I'm not paying the huge extrinsic value for buying the at the money. Normally with a calendar spread, you would buy an at the money call. I would buy a 67.50, which is a totally viable strategy and something I'm trying to replicate, but this trade does it so much better. So I'm just going to go to all here. We're going to look at these. And what I'm going to look for is the 90 delta. So I'm looking out at January 20th, 462 days, about a year and a half. And I look for this 90 delta and I'm going to buy one of those. And it's going to cost me a debit of 2,700. So this, if you recognize, if I was buying 190 delta and selling 1 at the money call, this would be a strategy called a poor man's covered call for those who are interested in that type of trade. And that's where this trade kind of started. I wanted to amplify the poor man's covered call. So what I'm going to do now is, this is the kind of fun part about a unicorn, is I get to adjust how much risk I have on. So right now, if we pull up the profile, you'll see that I'd be entering this trade for a debit. And since these are all calls, all of my risk to the downside is limited to the amount that I pay. Oh, no matter what price the stock goes to, I can never lose more than my initial investment. Now, the problem here with this is that I have a second naked call, and that's what I'm going to try to defend right now, is I'm going to arbitrarily pick some value of how much width I want. Now, obviously, I'm paying for this, so I'm out of pocket the money initially, which adds to my downside risk. But it also caps my upside risk if the stock goes up a lot. The other thing that can happen is if I can get in a position over the next couple of months to close out my short calls, I could potentially have a long call that ends up in the money and having more value than I paid for it, which is an amazing attribute of this trade and why I like it so much. So in this case, 67.50, I might say, well, I want to put on, say, 87.50. That would give me about $2,000 of max risk. So I would buy an 87.50. And that's as simple as this is. I literally am selling 2 at the money calls in a short duration, and then I'm buying an in the money call at 90 delta, and then I'm buying an in the money call to limit my upside risk. Now we're going to take a second for this performance graph to load up here, and we're going to see exactly what the break-evens are on the short term, but really these trades are actually a long-term trade. Because I'm using calls and because I'm buying this 90 delta, it's essentially like buying 90 shares of stock, and it is a long position. Now you can see the profit or probability is only 27%, and that's because there's a very, very small window here. What happens is you get this really nice big spike, and which is why I called it the unicorn, because it's just an amazing sharp trade. And if that stock trades anywhere here, it can make a substantial amount of money. I mean, we're talking about a $2,800 investment that could make up to $78 every single week. So if we did that math, say it made even part of that, $50 a week, 50 times 52, over the course of a year, this is going to make $2,600 in decay if the stock stays exactly where it is. Now, I don't really expect it to, and that is where we start to have to manage this trade. Now, it's a lot easier to manage it to the upside than it is to the downside, but our downside risk is limited to the initial debit anyways. So I really feel comfortable with this type of thing. Like if I'm going to throw $2,800 at a trade that's going to potentially make me up to $70 a week if it doesn't move, and has an easy adjustment to the upside because it's a long stock position, and it's way better than a calendar spread because it's got a calendar spread consists of only a single short call and a single long call, and both of those are at the money, which means you're paying a huge amount of theta decay. Even though it's way out in time, you're paying a larger theta decay for the at the money because the extrinsic value is greater for at the money calls. Because I'm using these calls, the ones that I'm buying are way out, they have very little extrinsic value. So I save that, I'm out of pocket less in the beginning. Also, when I adjust this, I can kind of move those two strikes around because I have two options. So instead of having a single strike short call as in a calendar, which I can only move that one option, I now have two options, so I can kind of leapfrog them together, left or right, up or down, depending on where the stock moves. And it's an incredibly strong theta decay trade. And as my patrons know, I've been trading these a lot. We can see even when the stock price reduces, it's really easy to make a positive return. And ideally what we want is a bullish move. And that's part of why I'm looking at a trade like this in Micron, because if we zoom in on this, there's a potential that it could break back up towards its recent moving averages. And if it moves down, I've got limited risk. It uses, the margin can't expand. I didn't even talk about that. It doesn't matter how far down this goes. If you were selling a short put, the margin would expand. But in this case, because it's all calls, on the downside, there's no margin expansion. And on the upside, it's easily adjusted to compress that loss and actually make it a more profitable trade. Now, if you're interested in this strategy or other strategies, remember to subscribe below because I love making money and I want all of us to get rich together. Thanks so much for watching and see you very soon.